Everyone wishes to have a financially secured future, especially for the uncertain times. Financial security can be achieved through right proportion of savings and investments, but the proportion varies for every individual depending upon their financial goals and liabilities. Saving and investing money serve different purposes and play different roles in your financial strategy. For example, suppose you have monthly SIP of Rs 10,000, home loan EMI of Rs 25,000, monthly expenses of Rs 30,000. Then it is advisable to have reserve funds or savings from Rs 2 lakhs to Rs 4 lakhs, so that for some reason if your salary is not on time, or if there is a loss of job, then there are enough savings with you to support for another 3 to 6 months. Hence it is necessary to be clear with this fundamental concept before you begin your journey to building wealth. Here are the key differences between the two, and why you need both of these strategies to help build long-term wealth. Number 1. Period. Savings are typically for small financial objectives to be met in short periods of time, say about 1 to 3 years. Examples: to buy a mobile phone or to go on a small domestic vacation in near future, emergency, etc. On the other hand, investing is typically a long-term plan for bigger financial goals. Examples: planning for your child's education, or wedding, or your comfortable retired life, which is due in about 5 or more years ahead from now. Number 2. Risk. Savings in reputed banks is safer, because risk of losing money in savings is very low, compared to any investments. We have options to invest in fixed deposits, savings accounts, recurring deposits, or liquid funds. Investing in equity market is subjected to ups and downs of market. One might lose money, if not invested in quality stocks with long-term growth potential companies. Risk in investing varies, according to the channels of investments. Mutual fund companies provide the scheme details, thereby indicating the possible risk involved. Physical gold-based investments have risks of theft and hassle of storage. Real estate-based investments have risk of wear and tear. One need to pay property tax and maintenance for the property. Number 3. Returns. In investing, we want our investments to make us money, while the goal of saving is to keep our money safe, making very little return. In case you save in bank fixed deposits, on an average you may earn interest up to about 6.5 to 7% annually. Interest on savings accounts is often much lower. However, the investments in equity-based mutual fund carry much higher potential for long-term value growth. Quality investments have higher potential returns, ranging from 11% to 18% annually. Number 4. Inflation. Savings cannot beat inflation, due to lower annual returns. Whereas, investments can beat inflation in long run since annual returns are higher than the average inflation rate. Number 5. Access to money. At time of critical need of money, savings serve as handy cash. You may withdraw a part of your savings or the whole amount, as per your wish. But at times, you end up spending money you have easy access to. In case of investing, access to your money depends on the kind of investments you make. Open-ended equity mutual fund schemes allow you to redeem your investments anytime. If a large amount is invested in physical gold or property, it will take longer to encash same. It is possible to be a wonderful investor and have investment properties, but be unable to make ends meet because you do not understand how to save your short-term funds. You can save money each month, but long-term, those savings will not pay in retirement, and most likely will not pay for your children's college, making investing equally important. This should remind us how important both are, especially when done together. So do consider all the difference before planning finance. If you have doubts, do comment. If you like this video, hit like. Do share it with your friends and don't forget to subscribe our channel.